right, welcome to Peace of Mind Radio. I am Brian Ramsey. That's Chris Bond. That's Eric Douglas. And this is actually Eric's. Saw an article, a couple of weeks ago, maybe?
It was last week.
Okay, yeah, last week.
Yeah.
Pretty interesting article. We had seen information like this in the past, but it just came back out, and there's a little different spin on it. But this is really about how the media can or tries to bias your opinion based on what media source you look at, that you watch, right?
Yeah, well, I mean, it's one of those things we all know, right? If it bleeds, it leads in the news.
Yep,
and that's more or less when you think about traditional news sources, but really the same holds true for financial news sources. You know, they're all about ratings. They're trying to get eyeballs.
They're trying
to
to sell
screen.
advertising. Mm-hmm. Absolutely.
It's kind of a boring story when, long-term investments are going to do X over time, right? And that's not a very good story, right? So you want to focus more or less on the day's events, and they're trying to use quote-unquote scare tactics to get you invested in what's happening. And it's interesting because we all know that, but this is the first time I've ever seen any kind of data that correlates or shows or illustrates that topic.
Yeah, and we'll get into that in a few minutes. But it's what's interesting is I think a conversation came up in our staff meeting today, I think.
Yeah.
We were talking about, if you're looking for, where was it? Maybe it was last week. You guys don't know what I'm talking about. But if you're looking for information to support your view, you're going to go to that particular data source to be able to find the data that's going to fit around your, was it church? That's where it was. See, that's a rabbit hole. But no, it was talking about if you believe a certain set of ways of life or whatever, you can go out and find a source that fits your narrative. Right. And so we all have a judgment on whatever social aspect or financial, you name it, you can go find a source that's going to represent that. Right. And I think that's kind of what this is that to some degree, if you're sort of a negative Nancy, you're going to probably follow. Sorry to all the Nancys out there. I don't mean that, but you get my point. You're probably going to follow
the Karens were getting tired of being picked on. So. Yeah.
But you're probably going to follow a data source that's more negative in nature.
Right. Mm-hmm.
If you're more positive in nature, you're probably going to follow a data source that's more positive in nature. So, Eric, why don't you walk us through the article and the content of the article, and then Chris and I are going to share our thoughts on it.
Yeah, well, I guess first and foremost, I want to make sure I give credit where it's due. So this is a gentleman by the name of Ryan Hughes. He's an advisor out in San Diego, Bull Oak Capital. So definitely not trying to steal anybody's thoughts or hard work.
Boatload Capital?
Bull Oak.
Bull Oak.
Bull Oak. Okay. I thought you said boatload too.
I did say boatload.
So, but he does what we do. He does blog posts and podcasts and all that stuff. So.
Yeah.
Want to make sure we give credit where it's due. But basically what he did or his firm did over a period of 3 years from 2018 to today, they correlated or they were tracking what the absolute return of the S&P 500 index was. Absolute return, for those that don't know what that means, was the market up or down in a single day. So if the market on a Monday was up, it doesn't matter how much or how little it went up. If it went up, there was a check mark. If it went down, it came down. And they tracked the absolute return of the S&P over a period of 3 years and showed a really favorable return, well over, there wasn't exact percentages, but they were trying to show correlation between the S&P 500 and basically what the headlines were on CNBC and Wall Street Journal specifically post-market or after the market closed to see, okay, well, how negative were the headlines or positive were the headlines that they were seeing on TV versus what was happening in the markets. Right. So what I and we watch CNBC around here, although we don't watch it all day every day, right?
No.
But we do kind of catch the headlines, and we have to just to kind of stay up.
It's up on one of the TVs.
Yeah,
so you can,
it's background noise.
Yeah, exactly. But I think what they were doing was immediately after the market closed, there's always this breaking news. Although if you watch CNBC or everything's breaking news, and it's breaking news all day long. Yeah. And so, but at the end of the day, they're taking that particular headline. Now, here's a little bit. We talked about this pre-broadcast. And what they do is they look at that particular headline and they make a judgment call whether that headline is positive or negative.
Yeah.
So you never really know the intent of the architect of that particular headline, right? Mm-hmm. So you don't know if they're trying to be positive or negative. So there is some of that, but if it's negative, then it became essentially a negative one, right? Is what they're saying.
Basically,
if it's positive, it's a positive one. And that's how they did it. So again, this goes back to, and you can go into this chart. And actually, can you load that chart on?
Yeah, we'll put a link to the article, absolutely, wherever we post links to this podcast and this YouTube video.
Cool.
Yes.
Yeah, but it's got a pretty cool chart on there. You might want to go check it out because it's what is it? The absolute S&P 500. You can kind of see does kind of one of these numbers, right? And then you have the Wall Street Index, which shows it's more positive. It's less positive than the S&P, but more positive than CNBC. Mm-hmm. And CNBC, you would think the world's coming to an end.
Apocalypse.
If you look at it. But here's the thing, and we've always said this, Chris, I know you say this quite a bit, is if CNBC was all, roses and then your naysayers would never watch it, right? Because they're like, oh, they're always positive, so they never watch it. Yeah. And I got to believe that, I don't know this. This is a Ramsey statistic, not the Dave Ramsey. It's the Brian Ramsey statistic. But I got to believe that there's more people that are going to follow negative news than follow positive news. So if it's always negative, you're going to have more people watch because it's negative, and than if it was positive.
It's the whole rubbernecker thing.
Yeah,
you don't rubberneck on the interstate because there's a pleasant thing happening. You rubberneck because there's an accident. It's just we're naturally drawn to that.
How many calls did we get in 2020 this time last year when the market was crashing?
Right.
How many calls did we get the second half of the year when the market was nothing but up?
Yeah, it's kind of the same thing.
Yeah, same thing. I mean,
we are drawn to negatives.
Yeah,
no
absolutely.
question. Yeah.
So after reading that article, what do you think?
Well, we kind of started talking about this just right before we started recording, so I hadn't had a chance to read the whole thing. But quite honestly, I'm not surprised. Eric had it right when we started off, and he said, this is the old traditional news thing. If it bleeds, it leads.
Yep.
Ultimately, the press is a free market business. They are trying to make money. They make money by selling advertisement space. And advertisers want to see, people that are actually paying attention to it. So, to your point, it's negative. We're drawn to that. That's the reason you're going to see things that are so much more negative here. Now, the Wall Street Journal, the two that are on here, the Wall Street Journal, CNBC. Who is reading the Wall Street Journal and consuming that? Who is consuming the CNBC information? I think you're typically going to have a little bit more of a sophisticated investor reading the Wall Street Journal than you would CNBC, so they're not necessarily going to need as much negative to keep them. That's the immediate takeaway that I get. We were talking about this earlier when we were bringing this subject up. I think the big issue here is most of the information that you're consuming from these sources has absolutely nothing to do with your long-term retirement type investments. That's where you get in trouble. Eric and I were talking about, how many times do you get a client call you and say, hey, the market is up. Why am I not up just as much? Because you're not invested in the market. That's not what your investment portfolio is. Yours is different. So that's kind of my takeaway immediately when I see this.
Yeah, I think that's that's a good point. That's one of those that, as I've been in the business almost 20 years, and over those 20 years, we've gone through a lot of different market cycles.
Yeah.
And it's interesting when, to your point, when things are good, we don't get that many calls because the media, whatever they're consuming for their daily intake of what's happening in the economy, really can't be so negative because things actually are pretty good, right? Yeah. But when things are bad, the headlines become worse and they make things sound a lot worse than they really are. Right. And then you've got people calling up, saying, hey, panicking, hey, I want to get out of the market. When in all reality, the headlines, if you will, are not, they're super negative, but may not necessarily reflect how the market really is.
Yeah.
Well, even
makes it worse.
Well, even right now, we've just been hitting all-time highs in the last few weeks. You still see. we don't watch CNBC all day long, right? But you walk past and you see a headline, and it's a negative headline, and earnings less than expected, or whatever it is, and it doesn't really correlate with what's truly happening in the market. So they're always trying to find the quote unquote negative, or what's going to lead, or what's going to draw eyeballs. Right. And generally speaking, it's not going to be a blah type of a headline, but hey, everything's kind of going according to plan. Everything's normal, right?
Well, Brian, you said it a minute ago, and you said everything's breaking news. Well, breaking news is not, hey, everything's wonderful. Yeah. Breaking news is something bad has happened. It's trying to get your attention. So they might even be talking about something positive. But the headline that's actually scrolling across the bottom of the screen would be the negative thing because it gets your attention.
Or it's giving incomplete information.
Absolutely.
And I'll give you, and I've had this conversation with several people over the last couple of weeks, ever since the new tax proposal with the long-term capital gains tax proposal at 43.4%. I believe that's the exact one. Well, the proposal is for anyone earning over $1 million.
But they don't put that part on the caption.
That part's not in the headline.
Right.
The headline is there's a new tax increase, 43%. Well, that's not really the entire story.
Right.
So
it's a teaser.
Exactly. And so when you actually look at everything in context, which most of the headlines lack context,
right.
It's a lot easier to understand, okay, the world's not ending, guys. It's okay. So.
Yeah, I'd say the biggest takeaway when it comes to headlines, and when I was reading this article, the thing that came to my mind is what Chris was hitting on a minute ago, and that is if you're an investor and you're sitting around watching CNBC or reading the Wall Street Journal in this case, or whatever content you're absorbing, at the end of the day, all that really matters is it depends on what phase of life you're in. One, if you're in a younger phase of life, so let's say you're 20 to 40s, are you putting away as much as you need to every year, every paycheck, or every month, however you want to look at it, so that you can accumulate enough assets so that at some point in the future, those assets can then be turned on to give you a lifetime income for the rest of your life, or give you an income for the rest of your life, however you want to look at it. And then two, if you're in the distribution phase of life, are you protecting your assets and managing your assets to the point to where all your assets you've accumulated throughout your lifetime are going to provide you the income that you need, and you're not going to outlive it. And number three, what happens when you're gone? You make sure that your assets go to who you want, when you want, how you want. That's really all that matters. So you can look at all the headlines all you want, negative, positive. Mm-hmm. You can stare at mutual fund performance every single day, but at the end of the day,
you can make yourself crazy doing
you can drive yourself nuts. Yeah. I mean, honestly, this is what we do for a living, and I don't know, none of the three of us watch this stuff hour by hour, day by day, headline by headline. We just don't do it because we've got a plan in place. We all do. The majority of our clients have plans in place. Now, some of them don't for various reasons or whatever, but we have a plan in place that says, yes, as long as I continue to do this, I'm going to be fine. Right. I'm going to be able to achieve whatever goal, financial goal I have. That's the most important thing. The headlines, it's just noise. That's how I see it.
I think that's wise. I can't tell you how many people I've spoken to over the last year that have said, you know what, I've just stopped watching the news and I feel better. Because I'm not constantly getting inundated with negatives. And I think the same thing applies to this kind of article is, to your point, Brian, if you've got a good financial plan and you're saving what you need to, especially if your horizons are right, staring at this stuff all day long, every day, looking at all the negatives. And there was a map in here about the different words and everything and how much they get blown up. Staring at that stuff all day, every day will make you insane. And it'll make you miserable. So maybe turn that off.
And it's amazing how much of it is actually pretty repetitious from day to day.
When
you actually do pay attention, like they were just talking about this. You get the same talking heads talking about the same things on a pretty regular basis. And, you can correlate that to news media or whatever sector that you want to correlate it to. But you just can't pay too much attention to that stuff.
Why drive yourself mad?
Exactly. Financial planning, if you've got a financial plan in place and you've done the work on the back end to make sure that you are not too aggressively or too conservatively invested as long as we're meeting your goals, investment return is only a piece of your overall financial plan. So.
Boom.
Yeah, completely accurate there. All right, so any other lasting thoughts, or are we going to, is that kind of it on that particular topic?
I think we drilled that one down.
Yeah, no, it's good. It was a very good piece, Eric. I appreciate you pulling that up. And so that's another edition of Peace of Mind Radio podcast. Next week, we've got an example of do we want to say client? Sort of a client, maybe, potentially. We're going to walk you through an example next week. So we've not done this in a long time. We did it when we had the radio show. We specifically walked through no names or anything. We're not going to divulge names. Well, we sort of will on this one, but we won't. So we're going to walk through everything about this particular client, and then I'm sure that's a teaser.
Little teaser.
Yep. So make sure you tune in next week. And by the way, if you want to look at our previous shows, go to Peace of Mind Radio podcast. You can see any of our previous shows. We also have two other podcasts. One is Connecting the Commonwealth, which Chris just did one earlier today.
Yeah, just earlier today.
So that'll be coming out in a couple of weeks, probably, Eric, something like that.
Yeah, we're a little backlogged on those, but yeah, we have a couple more coming out before that. Yeah.
Yeah. So anyway, that particular podcast, all we do is talk to entrepreneurs, business owners here in town, and give them an opportunity or a platform to be able to promote their products and services. That's all it is. It has nothing to do with financial related products, topics, whatever you want to call it. It's purely about that particular business owner. If you are a business owner and you want us to promote your business service, call us. We'll be happy to put you on a podcast. And then we have a third one, which is my favorite, which is Burgers and Bourbon.
It's everybody's favorite.
It's everybody's favorite. Everybody wants in on that particular podcast because we get to talk about burgers and bourbon. It's pretty fun. So anyway, check that out as well. And if you got any topics you want us to cover on this particular show, Peace of Mind Radio, let us know. We'd love to hear from you.
I got one more thing before we wrap it up and give everybody contact information. Just totally off the cuff. We have a lot of fun around here talking about everybody's sock game. And I want to point out that we have given Eric a lot of grief, but he's trying today. He's getting his sock game on.
He is, yeah.
These were the socks that were at the front of the drawer today. So let's not say I was trying very hard.
But you got to give credit where credit is due.
That is true.
Eric was trying.
Yeah, so there you go.
That is very true. All right.
Sorry, I couldn't help myself.
Yeah, have a good week, everybody, and we'll talk to you guys next week.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and or legal advisor before implementing any tax and or legal related strategies mentioned in this publication, as IFP does not provide tax and or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources at IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and or legal advisor before implementing any tax and or legal related strategies mentioned in this publication, as IFP does not provide tax and or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.